I got a fun video for all of you today. It's going to be lighthearted. We're going to pit my TFSA against my margin account, and we're going to figure out who wins. We're going to just compare performance from week to week, over the past month, over the past 3 months, year to date, 1 year, and the all-time return. But before we get to that, before we check that out, we're going to just talk about portfolio construction as an income investor. I'll talk about the construction of my own portfolio, what makes them different, what are their purposes, give you a little bit of a back history, and maybe you can use this information as inspiration for how you educate yourself on building your own portfolios. Not copy. I always say that don't copy. It'll lead to ruin because your goals are not my goals. You just copy me blindly. Honestly, it's the worst. It's the absolute worst thing you can do for your own education in finance. You get more financial maturity when you take on the investment world on your own and make everything tailored to your own preferences and goals. So that always needs to be said, but sometimes, people need reminders of that. Okay, so let's start and get into portfolio construction. We're going to start with my TFSA. Now, I'm currently filming this on Monday, June 22nd, just so you know. So it's during the trading day. Now, some of these ETFs in here, what you're going to notice is there's a lot of all-in-ones in here, and that's by design. We got some index funds, which, USCL, 25% leverage, S&P 500, QQCL, 25% leverage on the NASDAQ. We got HYLD. I consider this a proxy index fund to mimic the sector mix roughly of the S&P 500. But it's more of a stock selection kind of fund, whereas the Global X will write the call options on the index. HYLD does it on individual companies within HYLD. Now, keep in mind, HYLD invests, or it is an ETF that invests in other ETFs. So those underlying ETFs, those ones write call options on individual stocks. Then you got HHIS, higher yielder. So I have that more for just kind of concentration, jump up the yield for life expenses. And then HDIV and BMAX, kind of, I wouldn't say a global, these are not global funds, but they are multi-geographical kind of funds. They do tilt themselves pretty heavily in North America, especially in the US, but that's kind of more how I see these kinds of funds. So there's a little bit of a mix in here, but what the overall theme of my TFSA is, very, very American focused, quite focused on all-in-one products. So a lot of these ETFs are becoming more legacy products. I wouldn't say that maybe just yet give them that title, but they have been around for a while. These funds are often maybe referred to as the flagship funds of each and every single one of the fund managers that have put them out. Brompton BMAX for sure is a flagship fund. HLD for sure is a flagship fund. HDIV and HHIS for sure. QQCL, USCL for Global X, definitely flagship funds for each fund manager out there. So you get the theme. American focused, all-in-one focus. Really what I'm doing out here, as I often say, stretching out, grabbing all corners of the economy, and I'm just riding the wave with the economy, but doing it through the lens of income. The TFSA, I do extract income from for my life expenses. For those who don't know, I'm currently on a paternity leave, aka it's my experimental retirement. I don't have to go back to work until October of 2027. So my TFSA, I just extract all the income from currently. And anyway, so simply put, that's really in a nutshell what this is all about. Don't need to overcomplicate it. It's really just, again, all-in-ones to drive the growth of the economy and doing it through the lens of income. All right, so that's the TFSA, quite American focused. Let's move over to the margin account. Now, the margin account's not going to be as big as the TFSA. I've had the TFSA way longer, and I only got into a margin account. It was in, around this time about a year ago. It was a non-registered at the time. A couple months later, I upgraded it to a margin account. Before we move on with the video, I wanted to do a quick plug for my tool that I've created called the Cover Call ETF AllStar Tracker. If you are new to Cover Call ETFs and you need a tool that combines information from the fund manager website and places like Seeking Finance, Google Finance, Yahoo Finance into one tool, this is the one-stop shop. It is the all-in-one ETF of sorts when it comes to tools. Whether you want to check out performance data, you want to look at distribution history, whether you're Canadian or American, there's over 400 plus funds in here, a resource tab for tutorial videos, and other links as well to enhance your education around finance, and of course other tabs as well that focus on tax information, distributions, average volume, AUM, yields. There's so much to explore in here. And anyway, that's going to be in the description below or the first comment that you see. It'll bring you to this page here. And then you can fill that out and you'll get it right away. But if there's any issues, well, you just email me. And there's also a Facebook group that you can make your suggestions on how to improve the tracker. It's emailed out on the 1st of every month. There's always expansions. July is going to see one of the most massive expansions when it comes to funds I've ever done. Around probably 70 plus funds getting added for the July tracker. So be sure to check that out in the link below. So in the margin account, what I got in here? So it's quite different. There's less holdings. And if you look at the I would say you look at the descriptions, you'll see Canadian, Canadian, Canadian. So why Canadian? Why not more American stuff? Well, I wanted a non-registered account, and well, as it became a margin account, that would do a couple of things. It would be a bit of a counter away from the concentration of tech, AI in the US. So that was one of the main reasons, is that the Canadian economy and the American economy, they diverge quite differently. So as I mentioned, the American economy, very tech heavy, very concentrated at the top in tech, right? Those terrific 10 names or Mag 7 names, but at this point with SpaceX in there, it might as well be the Turbo 10. Then you got the Canadian economy, which is structured so differently. At the top, our tech sectors, financials, energy, materials, utilities, those are our home bias sectors. And as it turns out, for income purposes, financials, utilities, energy works actually as a sector. Investing in the sectors I find to be quite a fruitful strategy. It gives me a few more options if I need to sell something off. I sold off an energy fund back in March as the stuff going on in the Middle East was pushing oil prices higher. So that was ENCL, 25% leverage on Canadian oil and gas. And I used the funds or the money, the capital gains I made off of it, which was around $8,000, and I put that in my TFSA. So that made sense for some. I didn't want to get rid of ENCL. I really did want to keep that fund, but I can't ignore the cap gains once it comes to a certain threshold. So I usually say around 20%. I'm starting to think about selling stuff off. As you guys are noticing, there's one fund that has obliterated the 20% threshold. So we'll talk about that in a sec. But anyway, getting back to one of the main reasons why the way this is constructed, diversification away from the US. Also, typically our yields in Canada are a little bit higher. Forget the cover call overlay because we have more mature companies, right? Like our biggest companies are over 100 years old. So that's not great for innovation, but it is great for yield. And then you add the income component onto it as well. And that just amplifies it even more so. Okay, so it's diversification away from the US, be a bit of a counterbalance. It was yield. And then also to just tax efficiency. With Canadian funds. So basically, if you're not familiar how the breakdown of distributions work, is that each distribution for tax purposes is made up of a couple buckets. You got return of capital, you got eligible dividends, you got capital gains, you got other income, foreign income, and then tax withheld. So 6 typically is the breakdown once it comes tax time. So for Canadian stuff, you're most likely going to get taxed in the most favorable income buckets or taxable buckets when it comes to those distributions, which are going to be, which is going to be ROC, return of capital, which is normally just, you can also refer to it as delayed capital gains. I got other videos on explaining the tax breakdown in a playlist, so check that out if you want to learn more about taxes there. But I don't want to get too much into it here. So, but that would be at least in the now. It would be ROC. And then the next, depending on your income level, lower income level, eligible dividends, more of your friend. Higher income level, cap gains going to be your friend. But those are going to be the three. Whereas other income, foreign income, going to get taxed at a marginal tax rate. So don't want that. So that's really the main three reasons I got into this. Performance, on the other hand, was not something, it was just like that was a cherry on top of the cake. I did not expect some of the numbers that we're seeing here from investing in just Canadian stuff. I got into sector funds, as I believe Canadian sector funds just offer more flexibility than investing in the indexes themselves. You get exposed to other sectors that I'm not really all that interested in. For me, it's Canadian financials, Canadian utilities, Canadian oil and gas. You see what's etchy? Well, this is just a conglomeration of all the best and the biggest stuff in Canada. Think rail, think uranium, think Canadian tech, pipelines, oil and gas, financials, and it's just a concentrated fund of all that kind of stuff. Gold miners as well. So that's why I like Etchy. It's like a concentrated mix. It's like, you could, I guess, think of it as sort of like a concentrated mix of dividend payers with a cover call overlay. But basically, some of the biggest companies, blue chip companies that we have here in Canada. But I like it for that purpose, sort of that all-in-one concentrated mix, and then rounded out with some sector funds. But again, you don't see ENC on there for oil and gas, Canadian oil and gas. I'm kind of waiting for that one to calm down before I jump back into ENCL. So it's just a waiting game at this point. Those are the main reasons why I hold these funds. It's pretty simple. Again, non-registered margin account. I upgraded to margin to also help out with this paternity leave for just the various expenses to support me, my wife, my 4 kids, and everything going on there. So basically, when this was a non-reg, I got into these funds, and then as I used margin, and I just bumped up these funds even higher, or I bumped up the amounts even higher, and just kind of made it a little bit more equal weight. Margin account, diversification away from the U.S., yields, tax efficiency. That's why I got into this. And then, of course, the TFSA, American focused. These are like, even though it's structured to focus on income, these are going to be the kinds of all-in-one funds that also have the capacity that I see to also get NAV appreciation as well, above just simply, say, reinvesting back into these kinds of funds, which I was doing for the longest time, but now I'm extracting that income. But I do have the confidence that a portfolio structured like this can also just grow over time very naturally. It's not going to go gangbusters, because income products don't typically do that, albeit some funds can show that based on concentration, based on sector makeup, based on what's the flavor of the day. All right, so enough of that. You get the idea. Both of these accounts are structured very differently. U.S. focus versus Canadian focus. But at the end of the day, who wins? Who's gonna win? So let's actually compare. Now, again, I'm filming this on June 22nd, which is a Monday. So the 1 day return, we got the TFSA down 0.19%. The non-reg margin account down only 1.4%. That's one check mark for the non-reg. But what about 1 week? The TFSA up 1.92%. So this is all-time. Now keep in mind, what you're seeing here is just the all-time return of the whole portfolio. Okay, so it's just taking into returns into consideration. It's not taking into account deposits and things of that nature. Okay, so you can see right there, just returns only. So up 1.92%, up 1.92%. What about the non-reg margin account? This one is up. Well, we're giving the check mark to the TFSA 1-1. All right, 1-1. All right, let's go over to 1 month. Up the TFSA, which is focused on the American stuff, up 3.15%. But what about the margin account? Over the past 1 month, it is up 4.6%. We're going to give a check mark to the non-reg margin account. So it's up 2-1 versus the TFSA. What about 3 months? The TFSA is up 20.44% in the past 3 months, whereas the non-reg margin account is up 24.26%. So that is another check mark for the non-registered margin account. So we're up 3-1. Can the TFSA make a comeback? Year to date, this portfolio, the American-focused TFSA, up 14.5%, whereas the non-reg margin account is up. Blistering, it absolutely crushes the TFSA. I don't even know what to tell you guys. That is not what I expected, but anyway, here we are. You basically are going to get the flavor for the 1 year and the all-time return. But anyway, up 48.68% year to date, which is just a monster return as an income investor. Then we got the 1 year. Okay, well, it's still pretty good. 1 year, 31.69%. What about the non-reg margin account? Whoa, it's up 91.29%, just grinding up and to the right into the green. I mean, as an investor, who doesn't love to see that? No matter who you are, no matter if it's the income, no matter if it's the capital growth, we love seeing these kinds of returns. It's just, to me, it's just so surprising that this account has just done so good, especially with all the negativity around, a Canadian capital flight, don't invest in Canada. There's nothing good coming out of Canada. Well, I don't know what to tell you, right? These results, they speak for themselves, at least in one portion of the Canadian economy. Maybe not the whole thing, but at least one portion. All right, we still got one more to look at, which is the all-time return. Now, this is where the TFSA jumps up, and especially because I've held it for so long. When did I get into this thing? Like early 2022. It kind of meandered. I mean, it didn't do half bad for 2022, especially when the market had dropped at one point by whatever that was, 20%? This thing actually held up pretty good. I mean, at its lowest point, it was down about 10%. And then slowly recovered, then it jumps up, and then, the tariff stuff, and then the Hormuz stuff, and then it just kind of keeps going up. Anyways, it's up 75.76%. What about the non-reg margin account? It's up about 91.72% in that period of time, and it's starting to look like a ladder just leaning against a house at this point. It's great to see this kind of stuff, but as any kind of investor, nothing ever lasts. Nothing. So you gotta make adjustments where you can. Normally, I have typically in the past have sold off stuff at around the 20% threshold, and I've allowed bank to just run. Probably a good idea, considering I had talked about doing that with bank at around 20%, but financials really just do have a hand in every single sector when it comes to capital projects. And so that I would say that was probably a good move that I didn't sell it off. I was still able to capture capital growth, but hey, at 44%, I mean, it's still on my radar as far as where else I can put that money. I would hate to see something like $17,000 in capital growth just diminish and go somewhere else. So phenomenal returns there. Even Utes has come up. This one has been just such a steady Eddie, and has been and like this being up 8% is actually like quite the high for it. And whereas Etchy has actually kind of just stayed around the same spot. Like this is a good spot. I like Etchy being right around here, maybe 15%, somewhere around there. If you could just I'm sure all the fund managers want their stuff to grow, and So I wouldn't fault them for that. I just like these ranges. It's a little bit of a buffer. I can extract the income, and no worries, at least when it comes to that. So everybody, hopefully you enjoyed this fun little comparison. You learned something about portfolio construction and just returns. And let me know down in the comments what you guys plan to do with your own strategies. And just let me know how you've constructed your own portfolios. I'd be curious to see that. And it would also help other investors as well who read the comments to these videos. So hit all the buttons that like and subscribe variety, and I'll see you all in the next video.